Gaurav sir, can you please unmute yourself?
So am I audible? All right. So good afternoon, everyone. So today we are here for a webinar on a very important topic, which is global trends in financial reporting and their impact on Indian companies. This webinar is basically being organized by the Committee for Members in Industry and Business, which is headed by its leadership by CA Dr. Anuj Goyal ji, who is the chairman, and CA Rajesh Sharma ji, who is the vice chairman. So this committee is basically a non-standing committee of ICAI, and it has on board as many as 4 lakh members and 9,85,000 students globally. It is basically facilitating and bridging. It's like a bridge between the members in industry and business and the ICAI. And it's a matter of honor for me and that I've been given this opportunity to be the moderator in this webinar. And I would like to introduce, although I do believe that everybody is aware of CA Dr. Anuj Goyal ji, as he's such a prominent figure amongst us all, but it is still a matter of honor for me. So I would just like to speak a few things about him. So basically, CA Dr. Anuj Goyal ji is a practicing chartered accountant and a Central Council member of the Institute of Chartered Accountants of India. He is one of the youngest Central Council member from the Central region. He has also served as a chairman of the Ghaziabad chapter of the Institute of Company Secretaries of India and the Institute of Cost Accountants of India. For us, for the Institute of Chartered Accountants of India, he has made some significant contributions to the profession with his extraordinary tenure of 17 years. 17 years in the Central Council, 3 years in the Regional Council, and 6 years in the branch. He has been the chairman of the Central India Region Council and the chairman of various ICAI central committees. He is also currently the chairman of the Committee for Members in Industry and Business, which has organized this webinar, and is also a chairman of the Taxation Audits Quality Review Board, as well as the deputy convener of Publication and CDS Directorate. He is a very goal-oriented man, as we all know him. He has a lot of focus on what he is trying to do and achieve for the profession. He has a vast experience of over 30 years and he has a reservoir of knowledge that is supported by various professional degrees, which include CA, CS, CMA, LLB, MCOM, PhD, DISA, and DIRM. He's a very self-motivated person who is very enthusiastic and hardworking, and who has proven to be a great source of motivation, especially for the youth like us. His contribution in the field of research and development have always been remarkable. In the capacity of chairman of the Research Committee, ICAI, he had conceptualized and introduced various initiatives to foster the research environment. And now I would like CA Anuj Goyal sir to please speak a few words. Sir, sir, am I audible?
Am I audible?
Yes, sir. Now audible, sir.
I'm really grateful that we are having very dedicated and devoted team led by CA Anita Suneja ma'am, the secretary of Committee for Members in Industry and Business. We are having Ms. C. Agarwal ji, and CA Lakshit. And we are having two very, very prominent resource persons, I will say, CA Kuldeep Kothari ji, who is having vast experience in the various fields of the profession and is contributing in a great way for the cause of the profession and members as a resource person also. And he is one of the rank holder and company secretaries as well as CA course. So welcome CA Kuldeep Kothari ji
Yes, sir.
on behalf
Thank
of
you, sir.
CMIB, and of course we are having CA Gaurav Salotra ji, our very prominent chartered accountant and moderator of today's program. Friends, we must, and we are having, I think, n number of delegates from each and every part of the country, outside country. On behalf of ICI, I welcome all of you on this very, very important webinar on global trends in financial reporting and their implications for Indian companies. And friends, we are very well aware that Committee for Members in Industry and Business is a very, very important committee of the Institute of Chartered Accountants of India, is having great responsibility to see that how we can make available the best of the accounting professionals of the world to the end users, to the industry and to the business. And in the same manner, there is great expectation from this committee as we are now every year close to 10,000 chartered accountants we are giving to the society with the rigorous examination system which we are having. And you must be very well aware that now we have decided that even the final examination will be thrice in a year, and we will be having the campus placement thrice in a year. So we are putting our best to see that how 80% of our newly qualified chartered accountants who are going for employment in industry and business, how we can come up to the expectation of the youngsters. And we are trying to see that how we can really do something very, very concrete for each and every chartered accountant who want to come into industry, who want to change the employment. And for that particular purpose, we are having very, very ambitious target to see that through our 24/7 job portal, how we can try to see that each and every chartered accountant, whether one is having 10 years of experience or 20 years of experience or 30 years of experience, how we can try to do the matchmaking, because there is great demand of the best of the accounting professionals, but the best of the platform is required so that we can match the demand and supply of the chartered accountants. And in addition to that, we are trying our level best to see that how we can contribute in the best possible manner for the chartered accountants, women in industry and business, because there is great expectation. We are having the best of the women chartered accountants, and you will see their pass percentage is better than boys. You will find more girls as the rank holders. So how we can really do something concrete for them also, how we can try to see that there can be a balance between their family and professional life. I think that is a big challenge before this committee. And friends, we are very well aware that we are having career ascent for the experienced CAs. We are having overseas campus placement program. We are having MDPP for the rank holders and general members, and CFO and HR meets, 40 under 40 awards and ICI awards. So a lot of things are in the pipeline otherwise also. And I compliment C. Anita Suneja ji, our dynamic secretary of the committee, who is putting her best with the help and support of her team to see that how we can really do something very, very concrete in this direction. Today's topic, global trends in financial reporting and their implications for Indian companies. We are having the best of the resource person Kuldeep Kothari ji. And friends, we are very well aware that in today's evolving business landscape, financial reporting is undergoing significant transformation driven by technological advancements, increasing stakeholders' demands for transparency, and a growing focus on sustainability and non-financial information. This webinar aims to provide valuable insights and practical strategies for CFOs and finance professionals to navigate the complexities of financial reporting and enhance the accuracy of their financial and non-financial disclosures. CFOs and financial professionals play a crucial and evolving role in navigating the global trends in financial reporting. Their responsibilities extend beyond mere compliance and now evolve strategic thinking, data management, and effective communication. And friends, I am quite confident that with the help and support of the best of the resource person, we will certainly be getting the desired objective in this very important topic, global trends in financial reporting and their implications for Indian companies. I will not be taking your further time as we are very eager to hear our learned speaker, Kuldeep Kothari ji. I once again welcome all our honorable delegates who are with us from each and every part of the country, rather outside country also, for joining us, and we'll try our level best to have the best of the virtual programs, webinars for all the members, particularly the members who are in industry. Thank you very much. Over to Sri Kuldeep Kothari ji.
Thank you, sir. Shall I start, ma'am?
Yes, sir.
Okay. Thank you, Anuj sir, for your words of wisdom. I thank you, CA Dr. Anuj Goyal sir, for giving me this opportunity to have this interaction with all of you. I would like to share one experience of mine, which I had with Anuj sir in 2021-22, when the world was going through a rough phase after COVID. It is his visionary thought and leadership which has given a direction that we chartered accountants can move further beyond traditional reporting, assurance and auditing function. When he was the chairman of research committee, he has given this vision of making Indian chartered accountants a truly global professional. And it was under his leadership only we started working and we started researching in this domain of financial as well as non-financial reporting, global reporting frameworks such as integrated reporting, sustainability reporting, etc. As said by Gaurav sir, doesn't need any introduction because he's a powerhouse. He's an inspiration for all of us. He has served for a very long period as a Central Council member, and he serves as an inspiration for all of young as well as other chartered accountants, because the passion and the dedication with which he is working for the cause of profession is unmatchable and commendable also. He provides not only a true motivation to all of us, but guidance into various topics, various new fields, various new domains, which can truly make Indian chartered accountants a global world-class professional, as we believe that we are the best suited person to be at the front footing of the global professional world. So with these words, I thank you once again, Anuj sir, for giving me this opportunity. Thank you, the Secretariat of the committee, Secretary Anita Suneja madam, for giving me this opportunity. Straight away coming to the topic, sharing the presentation. Is it visible on the screen, tech support? Is it visible on the screen?
Yes, sir. Please continue.
Okay, thank you. So when you talk about global trends in financial reporting and their implication for Indian companies, when you talk about global trends per se, so somebody will say that there are n number of global reporting frameworks in various countries, and if they are being operated into different type of legal and geographical domains. So how do I figure out that what is suitable for me as an Indian entity, or what is the best reporting standard to which I should benchmark? You just take an example, imagine trying navigating a complex journey with a piece of map only. Whether it will be possible, the answer is no. And the same thing has happened till date. When we were into traditional reporting, we were giving only a small picture of our company's performance in terms of financial statement. But the investors and the stakeholders demand a larger picture, a bigger picture, and a clear map for this. And that's why it is important that the shift has been done from black and white annual reports to traditional reporting system, which was confined to financial statement only, which has now moved to comprehensive integrated reporting of financial as well as non-financial data. So as the stakeholders demands more and the world is looking at a bigger picture, leadership has lightly chosen this topic of global trends in financial reporting. It is in continuation to the series of webinar which the committee is organizing under the able leadership of Anuj sir. In last webinar, we discussed about BRSR. We were not able to discuss about integrated reporting. So I'll take it forward from that, and then we'll try to discuss few other prominent global reporting frameworks, which I feel and which we feel based on our research that are relevant for Indian companies, that are relevant in the present era and present context. So moving forward, this on your screen you see the evolution of presentation of financial reporting or annual report, as I would say. It can be compared to the evolution of mankind, in which you can see on the screen that where from we have moved from a black and white of simple piece of paper, we have moved to comprehensive non-financial financial reporting. We are presenting thematic annual reports. We are presenting EIVI based annual reports, and this is all part of financial reporting framework. Friends, financial reporting framework doesn't only mean that you are confined towards presentation of financial statement. It means a lot more than financial statement. It requires a lot more than financial statement, and that's why we will try to cover in next one half an hour, 1 hour 45 minutes about this very important topic, which will eventually, I'll try my best to share whatever knowledge I have in this field so that we can start working in this domain also. It opens a new door of opportunity for all of us as a chartered accountant. As I said in the beginning, and I said by Anuj sir also, that we chartered accountants are best suited for this role. Our role is way beyond financial reporting, way beyond preparing financial statement, auditing financial statement. Now it is more about strategic thinking, providing a strategic reservoir, strategic thought process to the management, and to play the crucial management roles within the companies, whether listed or unlisted. So what has prompted this dynamic shift in this financial reporting landscape? As we discussed, first is investor demands. Now the stakeholders, various stakeholders, not only investors, various stakeholders are demanding much more information than they used to do in past. Now, as we see years progressing, things have moved beyond financial reporting. Things have moved beyond financial reporting, financial statement. Now, investors, stakeholders look for transparency and look forward-looking information as well as sustainability information in the annual report. Regulatory mandates. So we are living in a world, friends, where we are living in a generation where we say that I'll do it my way, but the regulator is saying that let's do it as I say. So there has to be a fine balance between what regulator requires and what we are reporting, because as the requirement of reporting from regulatory angle also, it is changing dynamically. It is very important for us to be at a level playing field and to adopt a balancing approach so that we don't overdo, neither we don't do something which is required by the law and which is mandated by the law. Technological changes. AI has shaken up whole the world, and data analytics, big data, AI is playing a pivotal role in shaping the future of how financial analysis, financial modeling, and even reporting is being done. A lot of tools have been developed and they are under development for collecting collation of data, analyzing the data related to financial as well as non-financial information. Because the understanding is that if you implement these tech tools, these features, these processes at the very beginning of the system, the very beginning of the your internal system where the data is being captured, whether financial data, non-financial data, then only you will be able to progress and give a requisite output, a requisite depiction of your company's true financial, non-financial performance. Then stakeholder capitalism, as we discussed in the beginning, not only investors, various stakeholders. Stakeholders are not only limited to shareholders, investors. They extend way beyond. It includes our vendors, it includes our customers, it includes the government, it includes the media, it includes the society. So the needs of the society as well as various other stakeholders has risen to a new level, and that has prompted this dynamic shift in the reporting framework system or adoption of new global reporting frameworks in Indian context. So if we try to discuss or try to figure out what all changes have come in past few years in the reporting system in India or annual reports per se. See, generally these webinars tend to be monotonous one, but I would request all of you to post your questions and whatever you want to ask related to topic or other than this topic which is related to this, you put your questions in the chat box so that we make it as an interactive session. So my first question to all of you, that what all changes according to you has come in annual reporting landscape in past few years. See, as we discussed in the beginning, as it was elaborated and rightly the tone was set by the chairman, Dr. Anuj Goyal sir, that see, things have moved from black and white reporting to thematic annual reporting. The role has shifted. It is the role of CFOs, finance professionals, finance leaders, chartered accountants is not limited to only preparing financial statement, getting the books audited or auditing the books per se. It has a very wide role now, and we have a very wide role and we have a very wide function to play with. Our role has moved to strategic thinking rather than being in back-end job. So my first question to all of you, that what all changes have come in this annual reporting system or financial reporting system? Any few you can, if you can list, it will be very easy based on the discussion what we have done till now. So I am again repeating the question, what all changes have come in annual reporting domain in past few years or past 5-6 years, which you have seen, because we all are chartered accountants and in one another manner we are connected, we are related to the capital markets also. So for all of you, till we get some answers, the answer from my side is on your screen. Things have moved from, as I said, black and white to a AI, VI based thematic annual reports. Digitalization is something which has changed. Reports have become more interactive as the demand of investor stakeholders have risen up to a new level. Cross-referencing of data. Why cross-referencing and interactiveness is very important. You will be knowing the fact that there are too many statutory reports which we need to compile while preparing the annual report. There is global framework which we are adopting, be it integrated reporting, be it GRI, or be it some other international reporting such as ESRS or CDP, etc. So in that case, interoperability of these frameworks, interoperability of these statutory frameworks is very important, wherein it is equally important that you make sure that there is no duplicity of the data. No data is duplicated. The information which was supposed to be received by the stakeholders is presented and communicated in the rightest way. So that's where cross-referencing as well as interoperability of these frameworks plays a very vital role. And that's what we have learned during our tenure with Anuj sir in the research committee. Thematic reports, as we have already discussed, transparency is something which is the core of our profession, also transparency, integrity, and independence. And now we are moving towards excellence and we are aiming towards excellence. Focus on sustainability. As we said, the shift has moved from financial to non-financial reporting to having comprehensive ESG disclosures as well as interconnectedness of financial and non-financial information is something which is very important. Because what we have seen and observed, that after introduction of these sustainability reporting frameworks or BRSRC, in some cases there has been a case that there is a difference between the data which is presented in the financial statement and data which is presented in the sustainability report as well as BRSR. The same thing which we discussed, we tried to share our view in the last webinar which was organized on 21st of March. Then integrated reporting is something which has gained a lot of traction and is becoming very popular in Indian context. Future strategies and goal and enhanced disclosures. So as we discussed in the beginning, what we used to do in traditional reporting was a piece of map that was there. But now the focus has shifted from a piece of map to a bigger picture, which is being demanded by the stakeholders. As we all know that no journey is possible with a piece of map. You need to have a clear goal, map, directions to reach to your ultimate destination. And that is what is prompted these radical changes, dynamic changes in the financial reporting frameworks, adoption of global frameworks also. So we'll discuss how it works. Majorly, it is on your screen. GRI is something which if we work in this domain, we all must be aware of. Global Reporting Initiative. It is one of the oldest not-for-profit organization which works in the field of making and standardized sustainability reporting framework for the companies. It has collaborated with IFRS also, IFRS Foundation also, after introduction of IFRS S1 and S2, which we will discuss in detail later on in this presentation. CDP, TCFD is basically an industry forum. It is a task force for climate related change and disclosures. Then integrated reporting, which we will discuss in detail, which we were not able to discuss in the last webinar. Why it is important in Indian context? Because when we talk about global reporting framework, there may be more frameworks than what is coming on your screen. But what is relevant for an Indian company and what is relevant in Indian context is something which we require to discuss in detail. Then comes CSRD and ESRS. CSRD and ESRS. CSRD is being developed by EFRAG, European Financial Reporting Advisory Group. It is something called Corporate Sustainability Reporting Directive. It is a mandate which has few basic principles, and out of which one basic principle is double materiality, which has gained a lot of prominence in past few years. We'll say that we have seen few of them. Somebody will say that we have seen some annual reports or some reporting disclosures which claims to be in a double materiality assessment in stakeholder engagement and materiality section. But whether it is truly a double materiality assessment, that is the point which we require to examine, because CSRD and ESRS are the only standardized framework, the first standardized framework which introduce and which conceptualize and standardize the concept of double materiality. We'll discuss about double materiality in brief in the later part of our presentation. PRSR. So, friends, India is one of the only countries which has a standardized formal way of sustainability reporting in form of PRSR, that is business responsibility and sustainability reporting. We delve into the same in detail in our last webinar. So we'll touch upon the base on the same in case if somebody was not able to attend the previous webinar. But why you'll see these arrows coming to BRSR? Because see, integrated reporting, we have only one directive by the regulator SEBI, which was issued in 2017, February 2017. Post that, there is no specific disclosure or specific regulation, specific circular which is being issued by the regulator. At that time, BRR was in place, that is business responsibility report, and it was thought that integrated reporting framework, which is suggested as a mandatory adoption, as an voluntary adoption for the top 500 listed entities by market cap, will play as an supporting reporting framework to BRR. But things have become more interesting and more complex post introduction of BRSR in 2021. Then introduction of BRSR core in 2023, and a lot of changes have happened in the regulatory landscape in past 2 years. So it is very important that we keep up to the pace so that we can remain relevant. And that's why leadership has chosen this topic. Why it has become important? Because as we discussed, it is specifically given in the guidance note of BRSR and integrated reporting also, that interoperability of these frameworks is something which is very important, because ultimate goal is to give transparent information and desired information to the stakeholders. The goal is not to give any information which is appearing at 2-3 places in an annual report or in a financial reporting framework. So it is very important that how do we interlink these reporting initiatives that the company is adopting, and what do we benchmark and how do we benchmark. So we'll start with the integrated reporting framework or integrated reporting, what integrated reporting is all about, because it is something which has gained prominence in past 4 to 5 years, and it has become one of the most adopted international global framework. GRI, we all know, companies are still benchmarking GRI standards after introduction or adoption of integrated reporting. Also, we'll discuss about that also, that what to be benchmarked when you prepare an integrated annual report, whether it is correct to say that I have prepared an integrated annual report while benchmarking the GRI standards, or whether it is correct to say that I have benchmarked integrated reporting framework, CDP, TCFD, GRI, ISSB, S1, S2, etc., while preparing an integrated annual report or annual reports. So we'll discuss all these questions and topics in detail, because I found that these are some relevant topics, prevalent topics, which and common confusions also which are there in the reporting fraternity. So as we discussed, integrated reporting was first introduced in 2013. An integrated reporting council was formed, which later was merged with or undertaken by Value Reporting Foundation, which was subsumed into IFRS Foundation in 2021. And now IR framework is part of the IFRS Foundation only. IFRS Foundation, we all know that the standard setter for international financial reporting standards, and it has issued two sustainability standards also, which we got a chance to study when Anu sir was the vice chairman of Sustainability Standard Reporting Board of ICI. So post introduction of IFRS S1 and S2, IFRS Foundation has taken a step forward to create a common global baseline where, like we say, that let's have a comparable financial statement, let's have a comparable non-financial data also. So to create a common global baseline, common global dictionary of sustainability standards, this initiative was taken. After 2013, in between 2013 and 21, and circular was issued by SEBI mandating or suggesting that top 500 companies by market cap to adopt integrated reporting as a voluntary initiative. And then I said that the things have become more interesting. They have become a little bit of complex also post introduction of BRSR core, which we will discuss how it has become. But before going into detail, what is integrated reporting? Integrated reporting is precisely holistic overview of your company's financial as well as non-financial information. It is more than ESG reporting. That's why whenever we discuss or we get a chance to share our views, we say that it is more holistic. It is more comprehensive in a manner that not only it gives a clear picture about your environmental, social, and governance related measures and performance of the company. It takes a step forward and it depicts a very important part of your organization's value creation process through the value creation model. There are 7 guiding principles and 8 core elements of an integrated report, which has been prescribed by the IR framework. It was last updated in 2021. One of the few common guiding principles of an integrated report is strategic focus and future orientation. Connectivity of information. Friends, connectivity of information, I'll use this word for a number of times during this session, because when you say financial reporting, when you say non-financial reporting, it automatically, cast an onus on the preparer of the report that whatever information is being given, it is interconnected and the linkage of the information is done in the rightest way. It should not look like that something ABC is given at one part of the annual report and some other altogether different thing is given at the other section of the annual report. So interlinkage of financial and non-financial information is something which is very important. Stakeholder relationships, materiality is again something which is very important. Though the IR framework doesn't prescribe any specific method to conduct stakeholder engagement and materiality assessment, but based on the global trends as well as seeing the future trends, we suggest that a company should do a double materiality assessment. It says that the materiality assessment to identify material topics, material issues for the company should be done once in every 3 years. Reliability and completeness is something which is very important part of IR framework. Then comes the consistency and comparability part. It is the basic principle of, friends, our Indian accounting standards also the information which is presented in the report, which is presented in the financial statement, should be consistent throughout the report, throughout the statements, as well as it should be comparable with the data which is given for the past year or the past reporting period. Why I say this? Because predominantly this work of IR is being done by branding and media agencies. And we have seen that selection of KPI is something which is very important and which is not done in a consistent manner. So for example, in 1 year, like if I'm depicting in KPI related to Andy hours for per employee, it has gone up. So I am depicting it in 1 year, but in the coming year, it has gone down and I stopped disclosing or declaring the same. So it will create an situation where the data which is given in the past year is not comparable to the current year. Why it is important? Because when you talk about value creation process, the value creation process in itself is kind of a capital account, friends. Let us understand in the simplest way we understand the finance. So there is an opening balance of your financial capital, for example, then through the business process or the value creation process, you introduce something. For example, input to your financial capital is your debt. Input to your financial capital is your equity share capital. Input to your financial capital is the additional investment that you have done. Then through your value creation process, output is generated. Output is your product and services. That is the first outcome which we see. Then outcome is there. What is the impact which we are creating in short term on our various stakeholders? For example, an outcome of a financial capital can be dividend payout, can be EPS, can be ROI, can be ROE also. Then comes the long-term impact on various stakeholders. That is where this concept of consistency and comparability comes into play. So the ideal value creation model, friends, should be such that it depicts the value creation process. It depicts the value created, preserved, and eroded throughout the years. Now, when you hear the word eroded, somebody will say that why or how we can disclose something which shows that the value is being eroded by the company. Your point is very valid and right. There may be a restaurant, there may be an non-adaptability to this particular thing that I depict a KPI which shows that the value has been eroded. But that should be the ideal case, because when you talk about transparent reporting, it means that you show the headwinds and tailwinds of your financial business and other performance of your company. It doesn't mean that I only show which is in favor of my case. And that's where the selection of KPIs, right KPIs, comes into play, because it is a strategic exercise which is required to be taken care of in every year when you select prepare in KPI universe, out of which you select that let's take these 5, 6, 7 KPIs or 3, 4, 5 KPIs per capital, which I will be able to disclose throughout the next 3 to 5 years to show that how a long-term value is being created, preserved, or eroded by my company. Then comes the 6 capital approach. IIRC has prescribed that it has to be a 6 capital reporting. And again, a very confusing question or a confusing statement which comes into my mind. We have seen it in many cases that people say that there is stakeholder approach. There is stakeholder approach and there is a capital approach which is allowed as per the IR framework. But it is not so. There is no as such multi-stakeholder approach in integrated reporting. When you see the IR framework as well as the guidance note or circular, the only circular which was issued by regulator in 2017, it only talks about 6 capitals, which we will discuss. We'll try to have a bird's eye view in the coming part. There is no other way you can prepare an integrated report, and if you are not following the 6 capital approach, it is mandatory for you to assess, identify, recognize, and disclose all these 6 capitals. And the interplay of these 6 capitals is also something which is very important and vital for a company from reporting perspective. Otherwise, in your report, you cannot claim, and you should not claim that it is an integrated reporting benchmarked with IR framework, because an integrated report can only be prepared after benchmarking the IR framework. There is no other way you can prepare an integrated report. The major components of integrated reporting, as we discussed, value creation process is something which is very important. ESG related disclosures is something which is very important. 6Capital, again, it is the heart of the integrated reporting framework along with the value creation process. Materiality assessment, though it doesn't prescribe anything about materiality assessment and stakeholder engagement, the manner in which it should be done, but it should be comprehensive. It should extend to each and every stakeholder of your entity. So the lowest as well as the highest stakeholders of your entity should be covered, should be heard of. And that's why we suggest that instead of doing a single materiality assessment, a double materiality assessment is required, in which we assess the impact of company on the ESG parameters, vis-a-vis we assess the impact of ESG related matters on the company's financial performance. And we derive an interconnectedness, we prepare materiality metrics, and we place all those material issues which are critical to the entity on the materiality metrics. Integrated thinking. So friends, integrated thinking is something which is the base of integrated reporting. When you talk about integrated thinking, you can say that it is all about connectivity of the information, interdependency of the information, two sections of the reporting framework, various factors, you can say, interconnectedness and interlinkage of various capitals, interconnected and interlinkage of financial as well as non-financial information. Because when you say integrated report, it doesn't mean that I am doing it for the purpose of writing or preparing a document. It indeed means that it is part of, it is origination of integrated thinking, wherein all these parameters are connected and are sued in such a way that it gives the correct picture, financial, non-financial, other performance KPIs of your organization in the rightest way, in the manner it is required by the various stakeholders of the company. How do I prepare an integrated annual report? This is the question which is often asked from us at various forums and various platforms. See, if I'm preparing a normal annual report, the next question will be, can I start doing the same from the very beginning? All of a sudden, can I do? If I'm not preparing an integrated annual report, is there any process or is there any stepwise model which I'm required to follow? If I'm already benchmarking my annual report to say other sustainability reporting standards, for example, GRI, if I'm preparing the report as in accordance with DJSI or S&P Global, will I be able to prepare an integrated report? So let's answer all these questions. When you adopt any new reporting framework or any new first time integrated reporting adoption is being done, then it is required that you have a sufficient internal system in place. It is not mandated that you can or you are required to go full throttle in the first go. It is suggested, it is given in the glide path to adoption of integrated reporting, also in the guidance note of IR framework, which says that you can very well do one thing, that let's prepare the integrated report first year for the internal stakeholders. Let's circulate in between your organization, between your various internal stakeholders, because when you prepare an annual report or integrated annual report, almost all parts or all departments, process owners of your entity are involved into this exercise. So it is very important that they all are aware of this change. They all are on the same page. So the glide path to integrated reporting adoption in itself says, let's prepare the integrated reporting first for your internal stakeholders and select, identify, and try to measure the KPIs which are relevant for your organizations, which are possible to be measured and disclosed by your organization. Then only if you feel that you are prepared to go public, then you can adopt a full-fledged integrated reporting and you can publish an integrated reporting framework. Why I am saying so? When you prepare and when you adopt an integrated report framework, then though it is not written anywhere, but it is an unsaid rule that once you prepare an integrated report, then there is no going back, that you cannot prepare and you should not prepare a normal annual report. So it is very important that I check the readiness of my internal system processes, whether they are in place, whether the data collation of the data is something which is very important. Sanctity of data is also very important. And almost all organizations these days taken reasonable assurance on select non-financial KPIs or select non-financial information, which is published in the integrated report also. So it is very important that I check the readiness of my organization. Then the second thing which is important, that I need to understand the business model as well as the value creation model which I am planning to prepare should come in such a way that it depicts the value created, preserved, and eroded for the organization throughout the year, depicting the interplay of various capitals. When you say interplay of various capitals, somebody will say, what are the various capitals? So integrated and integrated thinking and reporting, it has been dissected into 6 capital: financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital, and natural capital. And when you talk about, we all, as a chartered accountant or as a finance professional, we all are aware about financial capital. It is concisely, it means about your finances, it means about your funds, it means about your profit after tax, it means about your revenue, it means about your dividends payout, it means about your return on equity, return on investment, etc. But we understand about manufactured capital also if we are into manufacturing space. But what do we do if we are into service industry? What we understand by intellectual capital, what is human capital? It is about my human resources, skills, manpower, etc. Social capital extends way beyond to your relationship with your customers, to your vendors, to the society as a whole, to other stakeholders also, which are socially impacted or which are widely impacted by your company's operations. Then comes the most important part of this dissection: natural capital. How do I preserve, I create an circular economy, I preserve the economic resources, I carry out my business operations in such a way that it doesn't harms any of the natural resources. There may be a case that for example, in service industry, somebody will say that I don't have any direct or indirect emissions as such. I have only scope 3 emissions, which are related to my value chain partners, or which are indirect emissions related to my upstream or downstream partner. For example, I'm into a banking sector, or I'm into an insurance sector. So I don't have any manufacturing process. I'm not originating any of the emissions directly from my operational area. But in service industry, people do travel a lot for work. So there may be a case that if I'm traveling in an airline, it is consuming fuel, and indeed it is generating emissions. So they are called scope 3 emissions. So it is very important that I take care of my natural capital also. Even land is also part of a natural capital, because it is not for the purpose of doing only that I prepare an integrated report. I claim that it is an integrated report. I give all these capitals. I prepare a value creation model. We need to understand the heart of this reporting framework lies at giving a transparent picture to various stakeholders of value created, preserved, and eroded in short term, medium term, and long term. And that's where interplay of these all capitals comes into play. How my, for example, intellectual capital is affecting my financial capital. For example, the company has done a lot of R&D initiative to develop new technologies. It has spent 100 CR on developing new technologies, and reason of that expenditure, due to that expenditure, R&D expenditure of 100 crores, the company has saved say 20, 25, 30 crores rupees in its business operation. So that can be a way. See how intellectual capital is affecting. On the one side, it is having an outflow of 100 crores in terms of adopting new technologies or developing new technologies. On the other side, it is saving the money for the business also. How your manufacturing capital is affecting your natural capital, how your manufacturing capital is affecting your financial capital. These interplay of capitals, interlinkage of capital is something which is very important to be disclosed, and it should come out in the right way, so that it serves the very own purpose of preparing an integrated report. We discussed already that concept to implementation, how an integrated report should be prepared. First, it is to be prepared, as I said, it can be prepared and should be prepared internally for your internal stakeholders. Then you can think about going a step forward to apply those measures and data collection measures to your outside stakeholders also. Then on the third and fourth and fifth part, you can think about going full-fledged, full throttle and preparing an integrated annual report and going public also with publication of an integrated annual report. When you talk about various core elements of an integrated report, reporting boundary is something which is very important. We discussed the reporting boundary last webinar in BRSR also. And somebody will say that, is there any difference between the reporting boundaries as per BRSR, reporting boundaries as per integrated reporting framework? See, the answer is yes, that there is a difference, because in BRSR, it gives you an option to select a reporting boundary, whether you are reporting on standalone basis, whether you are reporting on consolidated basis. And if you have any exceptions to that also, that you can mention in your reporting boundary. But reporting boundaries mentioned in the section A of BRSR should be consistent throughout the section A. So is the case is with integrated reporting framework also. So when I prepare an integrated reporting structure, then reporting boundary and about the report or table of content is something which is very important. It comes on the top. When you prepare the reporting boundary, we need to assess that what all data is available within the organization to be assessed, to be collated, because see, sanctity of the data as well as collation of the data and then giving it in a report form is something which is very important. So if your entity is following standalone, consolidated, whatever basis, it should come out correctly on the face of your integrated report. So on the screen, we'll try to use more practical examples now so that it makes sense also. Whatever we discussed till now, you can see that how these things are implemented in reporting in practical world. So when you talk about reporting boundary, there are 4 examples which are there on the screen. Can anybody tell which of the screenshot or snippet is correct and which is incorrect? Can anybody answer this for me? I request all of you to share your views. Whatever answer you have in your mind, you please share it in the question answer or chat box so that we can understand your views also. So let me answer this for you. When you say which of the disclosure is correct and which is incorrect, it is a very difficult and subjective assessment which is required to be made. The disclosure which is coming on the left hand side in the top of the screen, which says reporting boundary, reporting period, scope and boundary. The IR report covers the statutory financial information, the activity of the company in so and so year. Whether it is correct? The answer is no, it is not correct. Why it is not correct? Because integrated reporting is way beyond your statutory financial information. It is way beyond your notes to accounts, your statutory reports, etc. It is a holistic report which extends to the non-financial performance of the company, and it creates an interconnectedness between the effect of financial performance on non-financial vis-a-vis effect of non-financial performance on the financial part of your entity. The second disclosure states that reporting boundary and scope, the integrated annual report for FY so and so presents information on financial, non-financial performance of XYZ company's operations from the period. Information in our joint ventures have been disclosed as relevant as any specific exclusions are provided in respective sections. Whether it is correct? The answer is not. It is not truly correct, because when you say that any specific exclusions are provided in respective sections, we don't anticipate or we don't expect the stakeholders to go pillars to pillar to have a look at what is being not disclosed, what is covered under reporting boundary, what is not covered under reporting boundary, whether your reporting boundary extends to your subsidiaries also, whether your reporting boundary extends to your say joint ventures also, associates also, what it includes and what it doesn't include is something which is very important to be taken care of. So I'll not say that this statement or this disclosure is correct, but yet we can say that it is better than the other one. It is better than the other one. Now coming to the third disclosure, which is reflecting in some maroonish, brownish kind of color on your screen. The integrated annual report extends beyond financial reporting and includes non-financial performance opportunities, etc. The integrated report includes statutory reports and audited financial statement, covers the financial, non-financial statement of the company for so and so year. So whether we can say that this reporting boundary is correct, the answer is yes, it is near to correct, because as we say that the integrated report is an holistic report and it covers, it extends way beyond the financial as well as in the non-financial sections. The reporting boundary should depict the same also. And that's why out of these disclosure, this particular disclosure appears to be more correct. I'll not say it is perfect, but appears to be more correct. Then coming to the materiality matrix, if somebody say that I'm showing this matrix as an materiality matrix in my annual report, whether I can claim this to be an materiality matrix as per IR framework, the answer is no. Because when you talk about materiality metrics, it is not ESG materiality metrics as being claimed by many of the companies. It is not ESG materiality metrics. It requires you to assess the impact of your company's performance, impact of a company's operation on various material ESG matters, and vis-a-vis the other impact of your various ESG material matters on your company's financial performance. And that's why we say that double materiality is something which is very important for the purpose of reporting stakeholder engagement. And only through the double materiality, you can figure out and prepare a correct materiality metrics. You can engage with all your stakeholders and you can anticipate the probability of occurrence of these various material IROs, as we call, impact, risk, and opportunities. Then comes on the screen another example of a materiality matrix. Whether it is better than the last one, the answer is yes. Why it is better? Because it have a comprehensive view of my entity's material matters, material issues, which I've identified through an comprehensive dynamic approach, and I've assessed, though they are not claiming that it is a double materiality assessment, but it is being assessed on both parameters, that the impact of these material issues on the company and vis-a-vis the impact of company's operations into these material issues. Now, as we discussed in the beginning, again, it is there on your screen. When you prepare an integrated annual report, friends, about the report section is something which is very important. It is very relevant, and it is the first section which sets out the tone of your whole integrated report also. When we say consistency and comparability, and when we say reporting boundary, accountability statement, your table of content or basis of preparation and presentation is something which is part of your about the report section. And as we discussed in the beginning, if you are claiming your report to be an integrated annual report, if you are claiming your report to be benchmarked with IIRC or IR framework, which is now under IFRS Foundation, we should not say, like I discussed, that it is, you read in the left hand side, it says that this integrated annual report is aligned to IIRC, it is aligned to Companies Act 2013, LODR, Ind AS, Secretarial Standards, NGRBC, UN SDGs. Some companies do write GRI also. On the other side, the same things have been written. Whether it is in correct depiction of the basis of preparation and benchmarking to reporting framework, maybe we might have different answers if you ask this question to different people. But if you take my opinion, I will say this is not the correct way to prepare to benchmark an integrated annual report. If you want to claim that your report is an integrated annual report, then it should be clearly benchmarked to IR framework only, taking into account the 7 guiding principles and 8 core elements of your IR framework. Otherwise, you should not claim your report to be an integrated report. In addition to that, if somebody says that my report is in alignment with Companies Act, my report is in alignment with SEBI LODR, my report is in alignment with Ind AS. So I feel that it can be given here as well as you can skip the same year also, because we do give this compliance statement in our notes accounts in financial statement. We do give this compliance statement as a part of MD&A, which is our statutory section, management discussion analysis, which is mandated and required by regulation 34(2)(e of SEBI LODR. So this can be skipped. Then accountability statement is something which is very important. The structure of integrated report, as well as the value creation process, as well as the interplay of capitals and various capitals, basic structure and overview should undergo a thorough review by the board of directors, and there has to be a statement backing, stating and certifying the integrity of the facts and data which is given in the annual integrated annual report, integrated section of the annual report by the board of directors. So it is very important. This exercise becomes more important from this perspective, that your board has to give an accountability statement in respect to your integrated report which you prepare. Then this about the report section is pertaining to a service sector entity. Previous one was related to manufacturing entity. So there may be a different way to present about the report or table of contents section. But what we need to take into consideration is that when you prepare about the report section or table of contents section, you are required to at least mandatorily give 3-4 things. One is basis of preparation, the framework which you have benchmarked, then the accountability statement, then reporting boundary, and in addition to that, a forward-looking statement, because there is a future outlook section which is required to be prepared, and a lot of data related to future outlook and assumptions which we use in while we prepare an integrated section of the annual report. So a forward-looking statement is required. In addition to that, if you can give in detail about your materiality determination, then it will be an add-on advantage. It will be an additional transparent compliance which your company might be doing. Then this integrated reporting about the report section is related to in service sector entity. It gives your screen, you can see about the report section as well as the TOC. Why I say it is very important, because based on this, the flow of your report will be dependent upon. Based on this, you can set the tone of your integrated section on your whole annual report. Based on this, you can identify that I'm not duplicating any information. I'm cross-referencing relevant information at relevant sections. This is related to about the report section of a banking entity. So I've tried to combine and collate a few of the snippets related to various sectors, entities related to various sectors, so that gives you a holistic way that how it is being prepared by various entities in a different manner. For example, somebody writes approval of the board, somebody writes accountability statement, somebody writes assurance statement. So it is not assurance statement, it can be approval of the board. Reporting boundary and period is something which is common throughout the time. Reporting principle and framework, I say that you need to benchmark. If you are claiming it to be an integrated annual report, only IR framework, no other framework is required to be benchmarked. In addition to that, if you do something, then you can write in addition to that, but you are not required to state the same for the purpose of claiming a report to be an integrated annual report. Then this is again a very good example of a comprehensive TOC, of a large conglomerate, which clearly depicts various sections of your annual report, various sections of your integrated annual report also. And cross-referencing, interlinking, and hyperlinking is something which is very important, because these days these annual reports have become very bulky. So as an investor, as a stakeholder, neither I am supposed to read all 400, 500, 600 pages of the annual report, nor I have time and expertise to extract the relevant information out of the 600, 500 pages of the annual report. So my report should be crafted in such a way that all sections are interconnected, they are hyperlinked with each other, and the information is presented in a lucid way, and there is no duplicity of data. So this is something I've compiled few examples of accountability statement of those who are charged with governance. On one side, you see somebody is writing it as an assurance statement. Whether it is correct, the answer is no. In the statement or accountability statement or statement by those who are charged with the governance, it is required that your board of directors, so those who are charged with the governance, given certification or assurance kind of thing, that the data and facts and figures which are presented in the integrated annual report are true and correct and true and fair. It is not an assurance statement, or you are not required to depict what assurance you have taken on your statutory as well as other non-financial section. Whether it is a management review, there may be a different answer if somebody other answers this, but according to me, again, this is not the correct disclosure. Board's approval can be a correct heading. Accountability statement is something which I feel is the correct way to disclose how your board's approval or your board's involvement in the preparation of this integrated annual report or approval of the integrated annual report is depicted. Then comes on your screen, the most important part of your integrated annual report is value creation model. Why we say that it is very important? As we speak and we progress further, the main principle of an integrated annual report is depiction of your value created, preserved, and eroded throughout the year in short, medium, and long-term horizon. So, how do you depict the same? You are required and you can depict the same through this value creation model only. This value creation model has few mandatory components or ingredients to it. Input will be there. As I say that you can compare it with an capital account statement in which you have opening balance, then you have transactions during the year, and then you have closing balance. So there will be inputs, then there will be the business process or business model of the entity, and then there will be outcomes and long-term impact of these various capitals and these processes on various stakeholders. You can additionally link it to various UN SDGs also for the purpose of disclosure. You can additionally link it to, if it is possible, to the extent possible, to NGRBC principles. You can very well link it to your key focus areas. So if you want to do something additional, there are n number of ways in which I can depict in a brief manner and additional information which might be relevant for the users of the financial statement, users of the annual report. But keeping in mind that I don't dilute with the very basic process of preparation of this value creation model. So what is there on your screen? Do you feel that it is correct based on what we have discussed? In my opinion, the answer is no, because this entity has moved from multi-stakeholder approach to capital approach this year. Previously, it pertains to last year only. So when you say inputs, they've given few inputs to each and every capital, say financial, natural, human capital, social relationship, intellectual and manufactured capital, but you are able to see the outcomes and impact on various stakeholders. So it looks like that it is kind of a blend of multi-stakeholder approach and capital approach, which is, I feel it is not the correct way to prepare an integrated report. Why so? Because as we discussed in the beginning, there is no other way you can prepare an integrated annual report otherwise by by depicting all these 6 capitals, by depicting the value created, preserved, and eroded throughout the years by these 6 capitals. So this is, in my opinion, not the correct way to prepare a value creation model. Is it okay? So if you compare it with the last one, which is there on your screen, this appears to be more compliant. But is it in the spirit in which it is required to be done by the framework? Still, the answer probably will be no. Why? See, the selection of right KPIs, right inputs is very important for this value creation process, for depiction of this value creation model. Second is that it is showing output, which is indeed it is outcome, not output. Then maybe some qualitative KPIs this entity has disclosed in the outcome section, and then the impact on stakeholders in medium to long term is missing. Whether the value was created, preserved, or there was no impact, or it was eroded in the previous year through this value creation process is something which is missing. So though it is better than, in my opinion, the previous one, but still I feel that it is not in the right manner in which it was required to be done. Then whether it is this value creation model which you are seeing on your screen, is correct. Now we need to assess whether it covers all the aspects of a value creation model which is prescribed by the IR framework. So you have inputs with you. For example, take in example of financial capital. We invested 135,000 crores in the group to maintain, develop operations, strong balance sheet with so and so amount of net worth. Then it is depicting the value creation process on the screen, the business model on the screen. Then there are outputs oblique outcomes. It can be said to be outcome also, that total value added in the year, EBITDA, so and so much, net profit. There can be a way that more comprehensive KPIs or more specific KPIs are disclosed in the value creation model. Say for example, dividend payout ratio, say for example, equity. So again, I feel what is missing, it is better than the previous one. But again, what is missing is the impact which your company has created in media. Linkage of capital, interplay of capital is something which is missing. These two things are very important part of the whole IR framework, and they are very significant also in terms of depicting the correct value created, preserved, and eroded throughout the year. But it is better than the previous one. Now, there is a value creation model, sample value creation model on your screen, which pertains to a banking company. So I would request everyone to please post your questions in the chat box or question answer section. If you have any type of questions related to integrated report or any other framework till now, you may please put your questions in the chat box so that we can have an interactive discussion. Then this is an example of value creation model for a banking company. Whether it is prepared in the rightest way, inputs are there, then the business process, interconnectedness, outputs, then the outcome. Outcome is, as I said, that output is something which is the immediate result of your various processes like financial capital, manufacturing capital, etc. And outcome is something which is a specific KPI that you are required to identify and disclose on various capital side. It has shown the linkage to various SDGs. It has shown the linkage to various risks also in form of these icons which are there on the screen. So whether it is covering the whole aspect of integrated reporting framework, again I would say it is missing on the interplay of capital. But when you scroll the annual report of this particular entity, you will find, I was not able to take that screenshot, that it has shown the interplay of interlinkage of capital at a different page, which also suffices the purpose. So this is probably, I would say, the correct version of a value creation model, how it should look like. Then this is the example of a value creation model. Whether we can call a value creation model as a business model or it is different from the business model, the answer is yes, it is different. Business model is the way your business operates, and value creation model comprises of your business model. Whether the value creation model or business model which is appearing on your screen is correct, maybe the answer is no, it is not correct. So we have discussed a bit about integrated reporting. If there is any question related to integrated reporting, you can post it on the question and answer section or chat box. I'll be happy to take these questions, or you can post your questions. We can take the questions in the end also. Now coming to the next big change in the sustainability reporting domain, which is introduction of IFRS S1 and S2. So as we all are aware, IFRS is the standard setter, global standard setter, which in general issues the standards for financial reporting, that is IFRS, we all know, and carving out some exceptions and making it fit in the Indian context. Indices were developed. So in IFRS came out with IFRS S1 and S2 in 2024. It is applicable on all the entities from 1st January 2024. So what is IFRS S1 and S2? Why it was important, and with what mindset probably it was issued? We'll discuss in brief about all these concerns in next 10 minutes. So IFRS S1 is basically it lays out the framework, or it lays down the groundwork of how a sustainability report should be prepared. The word which is used at multiple places is SRRO, sustainability related risk and opportunities. So your entity's approach to sustainability related risk and opportunities is something which is very important part of this IFRS S1. These are the four pillars which are appearing on your screen. IFRS S1 is based on four pillars: governance, that is overall structure and oversight structure related to your sustainability initiatives and sustainability function. Then strategy, your company's or your business approach to SRROs, that is sustainability related risk and opportunity. Then risk management is obviously something which is very important. It is part of your ERM also, but this is slightly different from your RMC approved risk and ERM. Then comes the matrices and targets, because the no, it is not important to have an ESG report, or it is important to have a sustainability report or sustainability initiative, but equally it is important to have some measurable targets and goals, so that the progress of your entity or the impact of your entity on these various goals and various natural ESG issues can be identified, can be assessed quantitatively also. So these are the four basic pillars of the standard S1. One more important thing which IFRS S1 talks about is interlinking and connectivity of financial information with the non-financial information. It says that your financial information given in your financial report should be interlinked with your information which is given over and above in the financial report, that is in the non-financial section. So it is very important. Then comes IFRS S2. It focuses on climate related risk, scope 1 emission, scope 2 emissions, scope 3 and goals and strategies, or climate resilience. The word which is used is climate resilience, that how your entity is gearing up or is prepared to take on the climate changes. Scope 1, we all know that scope 1 is the direct emission which is originated from your company's business operation. Scope 2 is indirect emission, or maybe you can say purchased direct emissions, or emissions which are originating from the environment related connected environment of your entity which it is operating into. Then scope 3, we write or we say it value chain emissions, that are the indirect emissions which are pertaining to your downstream and upstream value chain partners. And then climate resilience and climate goals is something which is very important. You can, if your entity is preparing an BRSR report, and if your entity is falling within the top 1,000 entities by market cap, you will be able to correlate and link it to the principle 6 of BRSR, which talks about various environment related parameters. Various 9 out of 9 core BRSR principles, 4 to 5 are out from principle 6 only. It talks about your water, it talks about your waste, it talks about your energy related emissions, it talks about your holistic approach of a company towards environment management. So you can correlate it to the principle 6 of your BRSR report. Then how do I take or conceive these standards in Indian context? They are not applicable in India because no such specific sustainability standards connecting with IFRS S1 and S2 has been issued in India. BRSR framework, I would say that it is very comprehensive and it covers all majority of the aspects, but yet there are few things which can be updated. But as far as my opinion concerned, if no separate standards are issued in line with the IFRS S1 and S2, then the changes or updates will be brought in the BRSR framework only, because it's a standardized set of framework in which ESG information is being reported. Why it is important? Because the world is a global village and Indian entities are operating throughout across the world. So if my entity has a business operation, has a business interest outside my country also, then these laws will be applicable in that country. So it has an indirect influence on my company's global initiative, global investors, sustainability initiatives. And what lies in the future? So as I said that it may shape up the updates which we will see in the coming future in BRSR. Why IFRS and S1, S2 was brought in place? See, the probability is that the thinking behind bringing out or coming out with these sustainability standard by IFRS board is to create a global baseline, is to create a global dictionary of sustainability reporting initiatives. So see, yeah, there are different countries, different continents, and different set of reporting structures are there. If your entity is applying IFRS or as we apply Ind AS in India, the reporting structure will, in terms of financial statement, will predominantly be same or in line or will be comparable. But when you talk about non-financial information, a lot has come to the stock in past few 4 to 5 years. See, for example, in Europe, ESRS and CSRD is applicable. Some countries following GRI, some countries following integrated reporting, some countries adopting BRSR. So how do I make all these sustainability related reports or sustainability related information comparable? So IFRS S1 and S2 might be a try to make sure that all these things come at a common platform and these things become comparable. Why it is important? It is important for us to prepare or to read and to research about IFRS S1 and S2, because if we want to be on a level playing field at a global level, then we need to understand the foundation of the same. We need to strengthen the data collection process related to various type of emissions or GHG measurement related initiatives which are required to be taken, because as I said in the beginning, use of technology, as said by Anu sir also, that use of technology or AI or tools is something which is very important to collect and analyze these data, because the data is voluminous, the data is critical, the data is complex. So you'll not be able to analyze, measure these data without the use of technology. Then improving the reliability of the data and building the climate related analysis capabilities are something which are required, and why we require to be in line with IFRS S1 and S2. Now coming to the third global framework, which is I feel that more relevant for Indian context, is CSRD, that is Corporate Sustainability Reporting Directive, or ESRS as you call it, European Standards on European Sustainability Reporting Standards. They are prepared by NFRAG. EUNFARG. So what is CSRD? What is ESRS? So CSRD and ESRS, gives you a standard set of topical standards for all these three parameters. E stands for environment, so there are E1, E2, E3, E5. Then S stands for social related parameters, S1, S2, S3. Then there is topical standards for governance also, which is numbered as G1, G2. So there are topical standards for different all three parts of ESG, that is environment, social, and governance. It gives you a comprehensive universe of material matters also, but I should not call it material matters. These are material IROs. So when you adopt double materiality, or when you say that you are aligning yourself with CSRD and ESRS, it means that your entity is applying these standards. It means that it is way more than the singular materiality assessment which we have done. Why I am talking again and again about double materiality? Because double materiality is the basis. It is one of the main basis and pillars of this EU CSRD initiative. So as I said, it has three type of topical standards. It has given a comprehensive list of say 43 or 53. I am not able to recollect. Material IRO's universe: impact, risk, and opportunity. Why we call it IRO, we'll understand it in the next few slides. But it is very interesting and very important, because, for example, if your entity is an MSME entity also, even if you understand, if you say that your entity is an MSME entity, it has a long-lasting impact. If my exports are towards or in the European markets, already we have came across many SMEs or MSMEs in which the buyers have started focusing on implementation of these sustainability initiatives, alignment of these Indian entities to the European standards also. So it becomes very important, and it is the first standards which lays down the formalized way of double materiality assessment. Double materiality comprises of impact materiality and financial materiality. But before coming to double materiality, let's drill down to deep dive into what is ESRS. ESRS 1 and 2 are related to journal principles and disclosures. Then, as I said, E1 to E5 is related to E1 is for climate, E2 pollution, E3 water, E4 biodiversity, and then E5 is for resource use. S1 to S4 is related to social initiatives, your human capital, as we discussed in integrated reporting, to related to your communities, your value chain partners, your consumers, and G1 is related to governance related structure. What is the basic concept under CSRD or ESRS? It is double materiality. So let us understand what is impact materiality. Impact materiality is identifying your company's actual or potential significant potential positive and negative impact on various ESG matters. So how do I assess this? So first of all, you need to prepare an comprehensive universe of material IRO based on your internal assessment. Stakeholder prioritization is something which is very important. Stakeholder prioritization in this exercise, the role of your KMPs or your management is something which is very important. You need to drill down to or come to a level where you identify these are the stakeholders which are more relevant and which are more connected with my entity's business operations, and which are prioritized by me in as a part of my stakeholder engagement process. Then I prepare a comprehensive universe of material IROs. Then I need to, through a survey, through online assessment, or through physical meets, etc., roll out these surveys to various stakeholders and assess and ask them these questions, whether they feel that the impact of a material IRO, for example, your entity is into service sector and it has identified responsible advertising as a material impact on your company's business operation. So you need to ask to your stakeholders whether they feel that the impact is actual or potential. Actual means that it is related, it is happening, and it is going to happen in the short term. Potential means that the impact is not in occurrence as of now, but it might occur in medium to long term. So it can be done on the scale of 1 to 5, just an example, or it can be done through other means, interactive means of surveys also, because the filling out a survey generally becomes a boring exercise and we tend to fill monotonous answers on various questions. So it will have a lot of questions also. So you need to, prepare your survey questionnaire in such a way that it is interactive, engaging, as well as short also. Then whether it have a positive or negative impact. If it has a positive impact, then you need not to ask other questions. But if it has a probable or actual negative impact, then the remediability of the same, that whether if the impact occurs, then how easy it will be to reverse the same, is something which is also required to be assessed if you are doing the impact materiality in true sense in line with the CSRD or ESRS principles. Then comes the financial materiality. Once I assess and collate this data, then in basis of this data, I'll prepare a list of prioritized material IROs based on my impact materiality. Then they are required to be assessed. This exercise will go simultaneously, hand in hand, but I'm telling you by segregating both the functions. Then comes the role of financial materiality. Then the question will be thrown to the stakeholders whether these IROs, which were identified as a material IROs, have a potential impact, how they can impact my company in financial terms. What is the likelihood? And if it is likely to occur, then what is the magnitude? Whether it will have a significant, it will have a minimal impact, it will have no impact, it will have a moderate impact. Then I would suggest that when you do these, materiality exercises, double materiality or singular materiality, and if you are preparing an integrated annual report, again, connectedness or interconnectivity of information between two frameworks is very important. So you need to put in question related to the time horizon also. So when you push these IROs to your stakeholders, material issues to your stakeholders, let's put an additional question or additional assessment criteria related to the impact of these IROs in terms of value creation, in short term, medium term, and long term, so that it becomes a comprehensive exercise. So we have already discussed that how double materiality works. Now I'll touch upon a little bit about BRSR, because though we discussed in detail about BRSR in last webinar, but still, see, when you talk about Indianized context, and if you say how these global frameworks are going to have an impact on Indian companies, so I don't see, frankly, any in the shorter time span, any specific sustainability related standard coming in line with IFRS S1 and S2. I don't see, it has not been done in past also. I have not seen, and I don't see any chances of any specific guidance note or circular on integrated reporting, because it is not governed by our regulator. So how do I blend this in Indianized context? How do I make it make the same in Indianized context? BRSR is something, is a place where you present a lot of information about your ESG initiatives. It is a comprehensive standardized framework which has tabular questions, which have subjective questions, which have yes or no type of questions, which have specific set of disclosure related to various policies related to NGRBCs, principle-wise disclosures also, climate-related disclosures also in Principle 6. So it is very comprehensive disclosures, and it is very important to understand that how do I prepare my BRSR report, because it is a statutory document. The other places where I'm putting up my statutory sustainability information might not be in, and is not a statutory document. So first of all, alignment of information at both places is something which is very important. Then whatever data I'm giving has to be double checked and has to be validated, because your BRSR core parameters are expected to go under assurance or assessment, as they say. Though the framework has not been developed, or it is not out for public till now, the onus is on the industry standard forum to come out with a framework of assessment, as they call it. There may be a case that this assessment or methodology or assessment guidance will be stricter, stringent than what reasonable assurance was, or it may be a case that it is on the lenient side. Whatever the case may be, but as a responsible organization, as a responsible company, our job is to, or as a responsible professional, our job is to present the data which is transparent, correct, and verified also. So sanctity of the data is something which is very important. Putting up the right systems and right processes at a place, right tools in place to collect the data, technical data, because when you prepare a BRSR report, when you prepare an integrated report or sustainability report, or as you see ESG ESG data reports, ESG data packs also, it is a separate set of booklet which many of the companies publish. It requires collection of a hell lot of data. So it is not possible, it will not be convenient, or maybe I would say appropriate to say that it is possible without the help of technology. So the more you use these new tools, cutting edge technologies, AI, you use systems and automated processes in place, it will make your job easy, and it will make the data more reliable and comparable also. So we all know the history of BRSR. I will not be discussing the same. Then what is BRSR? It is basically your responsibility and sustainability reporting. As I said, it is the only standardized framework which is there across the globe in terms of sustainability reporting. It has a bit of everything because it is very comprehensive. It was developed in 2021. It was revamped in 2023 post introduction of BRSR core. So it covers, it takes inspiration from GRI also, it takes inspiration from IR also, it takes inspiration from CDP, TCFD, etc. So this is very comprehensive, and almost everything is covered under BRSR. But it has certain limitations also. On the other side, when we say that it is a comprehensive framework, the other part of this is that it is a statutory document. So you will be very cautious in putting up the information, not quantitative but qualitative information also, that how do I put, for example, we came across one such instance in which a company was claiming that they are assessing 100% of their value chain partners. So they disclosed the 100% figure in it is a leadership indicator in principle 9, I guess. Principle 1, I guess, Principle 1, question number 9. So they disclose that 100% of the value chain partners are being assessed. Below that, they put in a asterisk and they said that we do assess only contractual staff which is employed in our organization, and we are doing our other CSR foundation or arm is doing n number of programs for common vendors or value chain partners. Whether it is a correct statement to make, the answer is no. But this is the way these disclosures are being made. So it is very important that we prepare and maintain connectedness of the information between financial as well as non-financial sections, as well as we prepare the data which is validated, verified, and which is collected in a ITS way. So as we discussed, PRSR has many type of disclosures: free flowing text, tabular questions, complex calculations, emissions related to scope 1, scope 2 and 3, predominantly in principle 6 only, policy related disclosures in section B, that is management principle and process disclosures, in which it requires to disclose various details about various policy related disclosures which are aligned with NGRBC's principles. So it is a comprehensive framework, but where we are standing. So as of now, in view of ease of doing business, so some of the requirements which were introduced earlier has been relaxed for this particular year, such as reporting related to value chain partners, value chain disclosures of ESG disclosures of your value chain partners. Previously, there was no capping. Then it was introduced that 75% of your value chain partners by purchase or sales are required to be reported. Then a 2% individual threshold was introduced. Now, for this year, for this year only, it has been deferred. So now it is intended to be made applicable from the next year, but time will tell that what is going to happen. Then about assurance and assessment, previously it was required that top 150 entities in last year and top 250 entities in this year are required to undergo a reasonable assurance. Now this has been changed to limited assessment, but we are yet to receive a formal disclosure format for this limited assessment. So there are many changes which are which have undergone in this PRSR core framework, but yes, still it is a maturing framework, and it will see many more changes related to aligning the PRSR framework with the global standards, as well as if there is anything which is required to be tightened up, then this will be done by the regulator in the due course of time. As I said in the beginning also, we are living in a generation where we say that I'll do it my way, but the regulator is saying, let's do it as I say. So when you do these statutory sections reporting, it is very important that you make sure that you are following a balanced approach, and nothing which is required is left from disclosing, and nothing which is not required is being disclosed. So this is something which is very important in terms of assessment of what I am going to disclose and what I'm not going to disclose. There are three parts of BRSR. One is related to general information, other is management and process disclosure, and third is principle-wise performance disclosures. I'll not discuss much into the same because we have discussed the same in detail in last webinar. But there are few key hurdles which I feel are common in the sustainability reporting. One hurdle is that it is very comprehensive and data-oriented disclosure. Not only BRSR, every sustainability report on non-financial data will be data-oriented and comprehensive. It has more than 180 quantitative as well as qualitative. If you add it, the number will go up. Disclosures which are required to be made. Some complex calculations related to GHG, waste, and water is required to be made. And the format is divided into various type of disclosures, such as free flowing text, such as subjective, such as descriptive answers, such as tabular. So it requires a due care and diligence while preparing and presenting this particular report. Carbon credit, I think we can skip. Assurance requirement we have discussed. So coming to a new topic or new dimension or domain to financial reporting, and why it is connected to financial reporting framework, though it is not directly related to reporting framework, but sustainable finance, green finance is something which is the talk of town, and it opens a new door of opportunity for the companies as well as professionals like us. So that's why I thought let's cover a bit of this sustainable finance in this global reporting framework initiatives, because it has been, it is developed in line with the ICMA, that is International Capital Market Association's guidelines, and it is developed in line with the international standards only. So SEBI has released a consultation paper last year, which talked about sustainable finance, which talked about green debt securities, but a formal circular and notification is yet to come. But it has given a glide path that how sustainable finance will work in India, though still the term sustainable finance is very popular among the industry. It is prevalent also. Without any standard framework in India, companies are raising sustainable finance, companies are raising green finance, companies are, if you are on the lender side, then you are lending the same also to borrowers. So it is the practice is prevalent, but why it is important, how you depict and what you understand by sustainable finance or sustainable debt instrument. So at global level, other than the description which is there on the screen, a sustainability related instrument can be dissected into two parts. Broadly, I understand one is sustainability bonds, other is sustainability linked bonds, that is KPI, sustainability KPI linked bonds. So what is the basic difference? Somebody will say they both look same. So if it is a sustainability bond, then it will have an underlying purpose, whether it is related to environment, whether it is related to social measures, or whether it is related to governance, not related to governance. For governance, there is no sustainability bonds. For example, if you are issuing the sustainability, raising the sustainability fund for environmental initiative or natural initiative, then you will issue green bonds. If it is for say energy, then you will issue yellow bonds. If it is for water related initiative, then you will issue blue bonds. So this is how a sustainability bond looks like. It has an underlying purpose related to ESG, E and S parameters, and a sustainability linked bond is not directly connected to an underlying purpose of water, waste, or say energy or other natural initiatives, but it has an KPI based funding that you can use these funds for whatever purpose you want to use, but then the specific KPIs which your entity has disclosed while raising this fund has to be adhered to, has to be achieved, and they will be monitored throughout the years also. So this is the basic difference between sustainability bonds and sustainability linked bonds or KPI linked bonds. Then they will be open to external review, because I feel that this reporting requirement will be embedded somewhere into BRSR only to make it more simple. And if it is project based, then the project based reporting will be required to be made. And if it is KPI based, then the external assurance on these KPIs which you have disclosed while raising the funds will be required to be taken from an external assurer. So this is briefly about what sustainable finance and sustainability linked bond means. Now, when you talk about ESG, we have talked about various global as well as Indian ESG reporting frameworks. Then this term greenwashing is something which is very important. See, we all are aware about window dressing. So what window dressing means to financial statement is greenwashing to non-financial disclosures. What window dressing means to financial statement is to greenwashing is to non-financial disclosures. Why it is important? Because the decision of the users of financial statement, the decision of investors, stakeholders is more dependent upon the non-financial information, the non-financial KPIs, the environmental KPIs, the initiatives related to ESG parameters, which the company is disclosing in its report, disclosing in its investor presentation, disclosing in its communication. So it is imperative that the data which is disclosed, the KPIs which are disclosed are verified, are true and fair and correct. So if any entity is disclosing something which is not there, maybe for example, if somebody has written in the last year's annual report, or say last year's sustainability report for 2324, that they'll be carbon neutral by 202425, that is 2425, and we are standing, we are past 31st March 2025, and that has not happened. So there might be a case that somebody might have invested or somebody might have made the decision to associate with the company based on that particular KPI, but it has not happened. So whether it will be covered under the term greenwashing, the answer is yes. But greenwashing can be, friends, intentional, unintentional. Intentional, there may be a case that I've taken a target, but later on I, come to know that it is not achievable. There might be a case that I am disclosing something knowingly that it is not going to happen. Or this is in case of intentional greenwashing. Unintentional greenwashing, one such example, we were going through the annual report of a very large listed FMCG conglomerate, and we have seen that at one place the lives impacted through the social CSR or society related initiative was given as, say, 10 million, and when we went to the BRSR report, which is a statutory report, the number was somewhere around 5 to 6 lakhs. So there was a very huge difference. So when asked, they said that the number which is given in the integrated report, or say social relationship capital, it is the cumulative number of lives which were impacted till date, and the number which is given in the BRSR is for the year. So these type of errors may also land you in the this red zone of unintentional greenwashing, and these are required to be taken care of. Why it is important? Because as I said, that non-financial reporting has taken up, the expectation of investors have risen up to a new level, and with introduction of new KPIs, new adoption of these global reporting frameworks, it is very important that these data are verified, and that's why we at the institute, under the leadership of Anu sir, also when last year in sustainability board, we tried representing the regulator that the assessment or assurance debate should not be done. It should be reasonable assurance. We should go a step higher, not a step below the same. And still we are awaiting the outcome, but the institute has tried its part to make sure, not for the purpose of creating additional set of work for the chartered accountants, because the assessment or assurance function is profession agnostic. As of now, it is profession agnostic. So anybody can be, if it qualifies within the criteria set by the regulator, can be a reasonable assurer or assessment provider for limited assessment provider for non-financial topics. But again, just to make sure that whatever is being disclosed, whatever is being communicated to the stakeholders is communicated in the correct way. So the role of non-financial disclosures we have already discussed. Now, in the since we are running short of time, let us discuss something about green do and don'ts of green debt securities, and a brief about IFRS 18 as well as IFRS 17, because when you talk about global reporting frameworks, why we talked extensively about throughout the presentation about non-financial, because financial reporting is predominantly, it is governed by accounting standards, it is governed by Indian accounting standards, SAMSI, etc. So there is nothing much globally we can align ourselves until unless a local Indian accounting standard or accounting standards is being prescribed by the standard setter. So green debt securities, these do's and don'ts were published by SEBI circular only. So as we discussed, it should maintain the highest standards of integrity while publishing any green debt securities. Any negative externality, that is headwinds and tailwinds, I said, that has to be disclosed. It should not be the case that I disclose which is only green and I should not disclose which is red. Ongoing monitoring is something project-wise and otherwise also which is required. Misutilization of funds, false impression and misleading labels. For example, cherry picking of sustainability data is something which is a very common term in the sustainability world. Cherry picking of data, it should be avoided. Coming to the last section of this presentation, updates about global reporting standards in terms of finance. So IFRS 18 will not only let us understand what is IFRS 18. IFRS 18 will change the way we present our financial statement, we present our profit and loss account. It will provide for a lot of subtotals which are required to be published along with the profit and loss statement. Though it is proposed to be made effective from January 2027 globally, but since the change is very radical, the change is very comprehensive. In India also, the institute has issued the guidance note on Ind AS 118, which will be the last date to provide the suggestions or the comments on this particular guidance note is 6th of May 2025, if I'm not wrong. So IFRS 18 will, change the presentation and disclosure. How it will change the presentation and disclosure? Your profit and loss account will now be segregated into 5 parts. Operating, investing, and financing. We all know how your company's earning, operating, investing, and financing income is required to be disclosed. Then there will be a section of income tax. Then there will be a section of discontinued operation. So your profit and loss format will change. It will undergo a drastic and dynamic change, and it will have these 5 subtotals. And importantly, these 5 subtotals will be required and to be linked to other notes to accounts and other various disclosures. There is a term which is used, MPM, that is management performance analysis indicators. So these will be the KPIs in layman's language. These will be the KPIs which you disclose in addition to your financial statement. For example, if I'm having a con call and I'm uploading an investor presentation, I'm communicating with the investor, I'm presenting some other KPIs in that particular report. For example, in financial statement, I'm giving profit after tax. But in investor presentation, I'm giving in KPI profit per employee, for example. Or if for example, if you're into insurance sector, you are giving insurance premium per employee, then in that case, these KPIs will be required to be reconciled with what your most relevant subtotal of your financial statement notes or accounts. This is a very important change which has come into place. Then Ind AS 118 we have already discussed. It is issued in line with the IFRS 18 and it is open for suggestions till 6th of May 2025. IFRS 17, friends, why it is important? It also opens a new domain of working for chartered accountants. IFRS 17 is insurance contracts. Our insurance sector and banking sector is looking forward to adopt Indian accounting standards in coming future. IFRS 17 was introduced and was made applicable globally from 1st January 2023. It was supposed to be made applicable from last year. Ind AS 117 was notified. There was a lot of buzz in the market about how do the companies approach to this. A lot of preparations were going on since years, yet the companies were not ready to embrace this change in the rightest way. Then this change is deferred by the regulator, that is IRDAI, to 2027. So now this will be made applicable from 2027. So we had ample time, because if I'm not wrong, the first guidance note on this IFRS 17 or Ind AS 117 was issued by our own institute in 2018. So it is 6-7 long years we have traveled a long way, and now time till 2027 is being given. So these are the basic changes. In addition to these, one important change which has come in last year in Ind AS 1. So you all must be aware that in order to align our reporting standards or accounting policies to more business relevant and substance based, Ind AS 1 was amended, and the concept of material accounting policy information was introduced. This materiality is, friends, different from what is given in Companies Act, what is given in our auditing standards, what is given in SEBI LODR. It is completely different. It has prescribed 6 conditions on which an accounting policy information is required to be assessed, and then in that basis, the materiality matrix is required to be prepared, and accounting policy information is required to be disclosed. It gives you a specific covenant also. It says that if there should not be any obscuring information. Obscuring information means that the information which is not supposed to be transpired or communicated to the stakeholder. There should not be, despite the fact that I've done the materiality exercise, but I need to make sure that there is no obscuring policy information in my material accounting policy. So these were the few important changes which has come in relation to financial reporting standards also. So with all these changes, adopting global frameworks, coming on the same page, creating a global level playing field, giving non-financial disclosures, there are some regulatory scrutiny which has gone up, the regulatory scrutiny from the regulators such as SEBI, such as exchanges, RBI, MCA, or other relevant bodies, as well as the expectations from us if we are if we are in the role of auditors, if we are in the role of assurers in this particular domain, whether financial, non-financial, has gone up to a significant level, because the society do look up to us in a manner that whatever we certify will be proven correct. So our responsibility has gone up as an auditor also, and there is an increased need of having internal control systems in place in order to implement, in order to adapt these global standards in the correct way. So what are the key takeaways and what is required in the future? As rightly said by Anu sir in the beginning, while he set the tone for the session, that usage of data analytics, ESG tools is something, investment in technology is something which is required. Integrated thinking is something which is required. And we need to develop a strategic thinking mindset within us as a professional, within the companies as an organization. And it is required to strengthen the governance also. So with these words, if there's any question from any of the participants, I'll be happy to answer those questions. Otherwise, I'm done with my presentation. Over to the secretary.
Yes, Kuldeep ji. Yes, there are a
Yes,
few
yes.
questions that we would like to address. So, can we just ask a few questions
Yes, yes,
that the
yes, yes,
participants would
sure.
ask? So,
Yes, yes,
one of the
sure.
questions that has been asked is that, is there any other approach that has been prescribed for preparing an integrated report, and to which framework it should be benchmarked?
So I think the one who has asked this question has missed. I have already clarified the same. There is no other way to prepare an integrated report other than using the capital approach, 6 capital approach. The multi-stakeholder model is more relevant for the reports prepared under GRI framework. IR framework only prescribes one model, which is 6 capital approach.
Okay. All right. There's another question which says, how do we identify or set KPIs to be reported under integrated reporting?
It is very important, Gaurav, and the one who has asked this question has gone a little bit deeper in the whole framework. Why it is very important? Because when you say KPI, when you say KPI, you mean key performance indicators, and in preparation of a KPI universe, which is consistent and comparable throughout 3 to 5 years time horizon, is something which is very important. Second, identification of a relevant KPI for my sector and my domain is very important. So there is no specific methodology which is suggested, but I think first you need to do your internal exercise, that what all KPIs are relevant for you in terms of your sector, and your peers are identifying. Then you can do a global benchmarking. Then you can do an internal assessment, what all KPIs you are assessing. Then after you collate all these three things, you put your strategic and future outlook into this, and then you match it with what all KPIs your entity is measuring or recording as of now, and you can record or measure in the future. Though only those KPIs are required to be disclosed and should be disclosed. Otherwise, you will end up in a situation that you disclose one KPI in 1 year, and in the next year you will not be able to disclose the same KPI, because either it is going down, or you have not assessed that correctly, that this KPI, how it is measured.
Okay. There's another question which says, the presentation mentioned a potential shift from assurance to assessment for BRSR core. What does assessment entail in practice, and how does the level of scrutiny compare to reasonable assurance?
See, Gaurav, as I already answered this question also. Previously, when BRSR core was introduced, the concept of reasonable assurance was introduced. And last year only, in line with the ease of doing business initiatives, the regulator has prescribed and said that the reasonable assurance will be moved to limited assessment. And as I said, under the leadership of Anush sir, we tried a lot, and we have given our presentation to the regulator that a stricter level of assessment is required, whether it is called assessment or assurance is required in terms of non-financial data, because it has become very important. So as of now, the status is as such that for this year, they've said that limited assessment will be applicable. I presume that it will not be a degree lesser than what reasonable assurance was, but still we are yet to see the official framework in which limited assessment and in the way limited assessment is required to be done. But the onus of coming out with limited assessment approach is sadly given to the industry standard forum, and we are awaiting the format and approach to limited assessment.
All right, well noted. Okay, and how will the implementation of IFRS 18, which is Ind AS 118, impact the presentation of sustainability-related financial information within the main financial statements?
See, when we talked about IFRS 18, I said that it will change the way the financial statements are disclosed. So every standard, whether sustainability or other ways also, it talks about interconnected net of information, and whatever data I'm giving in my sustainability reports or ESG initiatives, it should correlate and be reconciled with the financial information. So as we spoke about management performance analysis indicators, that is MPMs, or management performance measures, which is part of IFRS 18 or Ind AS 118's guidance note. So these are the additional KPIs which I do disclose in addition to my financial statement. So they will be required to be reconciled, if possible, if it is a quantitative KPI, to the most relevant subtotal. So in other way, it will put an internal check in place. If I'm adopting Ind AS 118, it will mean that I have reconciled, if the auditor has assessed the same, I have reconciled my most relevant subtotal with the quantitative KPI, which is being disclosed by me other than the financial statement. So it will have a lot of impact in terms of strengthening the internal checks and balances, as well as the disclosure of correct data.
All right. Okay. And the final one is, any update on the implementation of Ind AS 117?
Again, I think, sir, you have missed the last part of my presentation. I said that it was made effective in last year, but after a lot of presentation, the regulator IRDA has deferred it to 2027. So we hopefully see insurance companies, as well as if implemented, banking companies also implementing Ind AS. But 117 insurance contracts will be, as of now, the status is that it will be made applicable from 2027.
All right. Perfect. Then I think that is it. And so now I would like to thank you for giving this knowledge enriching session, which was a great, for enhancing the knowledge on all these matters. And we hope, that the committee does this wonderful job of again organizing these webinars on these very important topics, which are, going to take the professionals, in parallel with the global professionals, with all these webinars and with all the knowledge that the members can gain from these. And also I would like to thank all the people, all the participants who have joined in for this webinar and have devoted time to this, your very precious time. And also I would like to thank the leadership of the committee, CA Dr. Anuj Goyal ji and Rajesh Verma ji as well, for organizing these webinars, which will go in a long way to help the professionals. And I would like to close it with this. Thank you so much. And
thank you, Gaurav, for your moderation. In the end, I would like to place, first of all, my thanks towards all the participants who have listened to us for 2 hours, who have come in a large number from each and every part of the country and outside the country also. And I would like to place special thanks towards the chairman of the committee, CA Dr. Anuj Goyal sir, for giving us this opportunity, and moreover for conceptualizing these series of webinars and as giving a thought that how Indian professionals can be at a level playing field with the global professionals, as he believes, and it reflects in sir's work also, that we believe that Indian chartered accountants are best fitted to be the truly global professional, finance professional leaders. So with this, I place my thanks towards the committee secretariat also for seamlessly coordinating the whole process. Over to you, the committee secretariat.
all right, so we'll now close this here, and looking forward to having some more webinars and some more knowledge from you. Thank you so much. Thank you so much,
Thank you.
everyone.
Thank you, everyone.